Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 5th of August. I'm Daniel Lam, your host for the podcast. The macro narrative have changed dramatically. While the markets initially reacted positively to the FOMC meeting, risky assets have turned risk off over the last two trading sessions due to a series of weak macro data. Suddenly, nearly out of nowhere, we are hearing the word hard landing again in the press. And the market fear indicator, the VIX index, shot up above the cautionary mark at 20%. S&P 500 has been pulling back and now is less than 1% away from the key support level at 5,300, breaking which is likely to open the path to a deeper fall to the 5,000 level. So the July non-farm payroll rose by 114,000 workers, a sharp slowdown from June's downwardly revised 179,000 and significantly below expectations of 175,000. The unemployment rate unexpectedly edged 20 basis points higher to 4.3% in July, rising for the fourth consecutive month. Wage growth decelerated at a faster than anticipated pace, with average hourly earnings decreasing from a downwardly revised 3.8% to 3.6% year over year. Part of the rise in the unemployment rate can be attributed to an increase in labor supply, as the participation rate ticked 10 basis points higher to 62.7% over the month. But not all of the increase in the unemployment rate can be attributed to higher supply. The June jobs report suggests that demand for workers continue to slow and that the hiring rate has decreased. July's weak employment report makes rate cut in September a base case in capital letters. And now the key question about rate cut is no longer when, but how much. Now, although Chairman Powell dismissed the idea of a 50 basis point cut at Wednesday's post-FOMC press conference, several scheduled speeches will provide policymakers with an opportunity to fine-tune their communication between now and September the 18th. Now, what should we be expecting over the month of August? Well, volatility is very much likely to persist. This is a combination of growth slowdown fears and also disappointing results from some of the mega-cap technology heavyweights, leading to investors questioning if the AI-induced rally has been overblown and the unwinding of the overcrowded positioning continues. With US 10-year Treasury yield breaking below the key technical level at 4%, we expect investors to be rotating into US Treasuries and gold in the very near term. As discussed in the previous podcast though, we remain positive on the medium to long-term prospects over the AI growth space. We talked about scaling into Nasdaq 100 from the 19,000 level onto 18,200 levels and adding at key support levels for the US growth stocks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.